Hello, everyone, and welcome to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and thank you for joining me today. Whether you're actively trading the financial markets, investing for the long term, or simply trying to understand what drives global economic trends, today's episode is one you won't want to miss. We're going to explore one of the most important forces influencing financial markets around the world, the US dollar. More specifically, we're going to answer three key questions. First, what exactly are dollar cycles? Second, why do they matter to investors and traders? And third, how can understanding dollar cycles help you make better investment and trading decisions? The US dollar is much more than America's currency. It is the backbone of the global financial system. It influences currencies, commodities, stock markets, bond yields, inflation, international trade, and even the economic health of developing nations. Yet, despite its importance, many newer investors don't fully appreciate just how much impact the dollar has on almost every financial asset they own. By the end of today's episode, you'll understand why experienced macro investors closely monitor the US dollar and why understanding long-term dollar cycles can give you a much clearer perspective on what's happening across global markets. So let's dive in. What are dollar cycles? Let's start with the basics. When economists and market analysts talk about dollar cycles, they're referring to long-term periods during which the US dollar either strengthens or weakens against other major world currencies. These aren't the daily fluctuations you see after an economic report or a central bank announcement. Instead, these are broad trends that can last several years. Think of them as economic seasons. Just as economies move through expansion and recession, currencies also move through extended periods of strength and weakness. These cycles are influenced by many factors working together: interest rates, inflation, economic growth, government spending, global trade, political stability, investor confidence, and perhaps most importantly, global capital flows. When international investors believe the United States offers attractive returns and relative safety, money flows into American assets. Investors buy treasury bonds. They purchase U.S. stocks. They hold more dollars. This increased demand pushes the value of the U.S. dollar higher. On the other hand, when global investors become more confident about economic growth elsewhere, capital often flows into international markets, emerging economies, and higher yielding investments. That can reduce demand for the dollar and begin a weaker dollar cycle. Understanding these long-term shifts helps explain why markets often move together in ways that might initially seem unrelated. Why does the US dollar matter so much? Now, you might be wondering why one country's currency has such a powerful influence on the rest of the world. The answer lies in the dollar's unique position within global finance. The US dollar is the world's primary reserve currency. Central banks hold large amounts of dollars. International companies trade in dollars. Governments borrow in dollars. Most importantly, many of the world's largest commodities are priced in US dollars. That includes crude oil, gold, silver, copper, natural gas, agricultural products. Because these commodities are priced in dollars, changes in the dollar affect purchasing power around the world. When the dollar becomes stronger, buyers using other currencies effectively pay more for those same commodities. Demand often weakens. Commodity prices can come under pressure. When the dollar weakens, the opposite frequently happens. International buyers gain purchasing power. Commodity demand increases. Prices often move higher. This is one of the reasons commodity traders constantly monitor movements in the US dollar before making trading decisions. The Federal Reserve's role. No discussion about dollar cycles would be complete without talking about the Federal Reserve. The Federal Reserve has enormous influence over the direction of the US dollar through monetary policy. When inflation rises too quickly, the Fed often raises interest rates. Higher interest rates generally make U.S. investments more attractive because investors can earn higher returns from treasury bonds and other dollar-denominated assets. As global investors move money into the United States, demand for dollars increases. That tends to strengthen the currency. Conversely, when economic growth slows, the Federal Reserve may lower interest rates to stimulate borrowing and investment. Lower interest rates can reduce demand for U.S. assets and place downward pressure on the dollar. However, It's important to remember that markets don't simply react to current interest rates. They also respond to expectations. If investors believe the Federal Reserve will continue raising rates over the coming year, the dollar may strengthen even before those increases actually happen. Markets are always looking ahead. That's why experienced traders spend so much time analyzing future expectations rather than only today's economic data. How dollar cycles affect stock markets. Now, let's connect this to equities. Many investors focus entirely on company earnings and economic growth. Those factors are certainly important. But currency movements also play a significant role. Large multinational companies earn revenue from customers around the world. When the dollar strengthens, overseas earnings translate back into fewer US dollars. That can reduce reported profits. Exporters may also become less competitive because their products become more expensive for international buyers. During weaker dollar periods, multinational companies often receive the opposite benefit. Foreign earnings become more valuable when converted back into dollars. Exports become more competitive. Corporate profitability can improve. International stock markets often benefit during weaker dollar environments as well. Emerging markets, in particular, have historically performed better during extended periods of dollar weakness. Of course, every market cycle is different, but understanding these relationships helps investors appreciate why currency movements can influence stock performance across different regions. Commodities and the dollar. Let's spend a moment talking about commodities because this relationship is one of the strongest in financial markets. Gold provides an excellent example. Historically, gold and the US dollar often move in opposite directions. When the dollar strengthens, gold frequently faces headwinds because it becomes more expensive for international investors. When the dollar weakens, gold often becomes more attractive as both an inflation hedge and an alternative store of value. The same principle frequently applies to oil, industrial metals, and many agricultural commodities. That's why commodity traders rarely analyze supply and demand in isolation. They also pay close attention to currency markets. Understanding both sides of the equation provides a much more complete picture. Emerging markets and global capital flows. One area where dollar cycles become especially important is emerging markets. Many developing countries borrow heavily in US dollars. Infrastructure projects, corporate expansion, government financing, international loans. Much of it is denominated in dollars. When the dollar strengthens significantly, those debts become more expensive to repay. That places additional pressure on governments and businesses. Capital may begin flowing out of emerging economies and back into developed markets. Currencies weaken. Financial conditions tighten. Economic growth slows. When the dollar weakens, those same countries often experience improved financial conditions. Borrowing becomes easier. Capital flows back into local markets. Investment increases. Economic growth frequently improves. This is why institutional investors closely monitor dollar cycles before adjusting international portfolios. Dollar cycle investing. So, how can investors actually use this information? The goal isn't to predict every market move. Nobody can consistently do that. Instead, understanding dollar cycles provides context. It helps investors identify the broader environment in which markets are operating. During stronger dollar periods, investors sometimes favor defensive sectors, high-quality bonds, large-cap U.S. companies, and cash positions. During weaker dollar environments, many investors begin looking at emerging markets, commodities, international equities, energy companies, mining stocks, and other assets that historically perform better when the dollar declines. It's important to remember that these aren't rigid rules. Markets are complex. Every cycle has unique characteristics, but recognizing the broader trend often improves decision-making. Rather than reacting emotionally to short-term volatility, investors can focus on the bigger picture. Why every trader should watch the dollar. Even if you never trade currencies directly, the US dollar still deserves your attention. Forex traders obviously monitor the dollar closely, but equity traders should also watch it. Commodity traders certainly should. Bond investors benefit from understanding it. Even cryptocurrency traders increasingly pay attention to dollar liquidity and Federal Reserve policy, because both influence market sentiment and investor risk appetite. The dollar has become one of the central drivers of global financial conditions. Ignoring it means overlooking one of the most influential indicators available. Final thoughts. As we wrap up today's episode, I'd like to leave you with one important takeaway. Successful investing isn't simply about picking individual stocks or finding the next market trend. It's about understanding how the global financial system fits together. Dollar cycles connect interest rates, inflation, commodities, equity markets, bond markets, emerging economies, and investor psychology. The more you understand these relationships, the more confidence you'll have when markets become volatile. You'll spend less time reacting to headlines and more time recognizing the broader forces shaping financial markets. That doesn't guarantee success, of course, but it does provide valuable perspective, and perspective is one of the greatest advantages any trader or investor can develop. Thank you so much for listening to today's episode of Financial Market Insights for Traders. If you found today's discussion helpful and you'd like to continue building your understanding of trading, investing, macroeconomics, and global financial markets, be sure to subscribe to the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. Each episode is designed to break down complex financial topics into practical, beginner-friendly insights that you can apply to your own investing journey. And if you're ready to put that knowledge into practice, explore the powerful and intuitive trading platform from Crystal Ball Markets at crystalballmarkets.com/platform. It's a world-class, cutting-edge, user-friendly trading platform designed to help traders of all experience levels access global markets with confidence. Until next time, I'm Sophia, and this has been Financial Market Insights for Traders. Thank you for listening, and I look forward to speaking with you again in our next episode.